I want to start with this morning's PCE figure. Of course, coming in bang in line with expectations on pretty much every single measure. What do you make of a print such as that, where there were no surprises at all when you're thinking about how the Fed is actually going to proceed next month?
So with everything that we're dealing with this year, a number that comes as expected is actually not a bad thing. We're hoping for a quiet day. So it comes in as expected. To your point, it is above the 2% inflation target, but it was not higher. So at least that was good news, particularly as the Fed, as Chair Powell seemed to indicate, is on this risk management approach. We had that weak payroll report with the revisions. I think there's concern at the Fed, and I'm maybe part of that group, concerned about is the labor market losing momentum. And they know that monetary policy is restrictive. So I think the inflation report allows them to reduce the level of restrictiveness. We know we're living with tariff. The dual mandate of the Fed is in tension. But the inflation number hasn't picked up to the point where they might say that, hold off, we really can't start to cut rates. So I think the inflation report allows them to cut rates, as they've signaled. That labor report next week is really important, whether it's a 25, 50, what happens after the 25? I think that's what we need to see. We know the labor market's slowing. Is it slowing in line with structural issues because the break-even numbers are lower because of whether it's AI or immigration, or is there something cyclical? I think that's the big question we're grappling with. Ahead of that, I think the Fed, so what this means for the Fed is I think they can cut that 25. It's really what's next, how many more cuts, where's the end point? All of that, I think we need that labor report, I'd say more important than even that inflation print today.
Well, let's bring that topic over to George Bory, because Priya makes an interesting point that, okay, you take a look at the odds for a September rate cut, they're hanging out at about 88% right now. I'm going to go ahead and call that a lock. But when you consider the trajectory beyond next month, George, is it going to be the labor market that is the key?
Well, as Priya mentioned, it's very much, they're still data dependent. Whether we want to call it that or not, they are data dependent. There's certainly air cover, there's room, there's rationale to start to cut rates. The labor market is showing clear sign of deceleration, and there's a very mixed bag of growth. That on average growth also seems to be slowing, although the second quarter numbers still looked pretty solid, and third quarter is holding up reasonably well. But with the labor market showing signs of slowdown, they can cut. It's just a matter of pace. And I think that's what you're mentioning is absolutely critical. It doesn't appear to need to be fast and furious at this point, that you can start to incrementally lower rates, align that with a labor market that's showing some sign of softening. But you have to be very respectful of the inflation backdrop, which is kind of stuck. We're stuck at slightly above target. And the question is that going to go down? It doesn't appear to be going down anytime soon, but if the Fed wants to look out a little bit over the horizon and say slow and steady for now, and then we'll have to see how inflation evolves, that seems like a very practical, very realistic approach at this point in time.
Well, the phrase that we're using, George, stuck when it comes to inflation, I mean, I think the chart told the whole story. That looks like where we are. And I want to talk about this in the context of the Fed's dual mandate. You have the labor market, you have inflation, of course. That's what the textbooks tell us. Do you think that those two sides are in conflict? Because if I take a look at today's reading, core PCE on an annualized basis at 2.9%, if the labor market does weaken materially here, I mean, what kind of magnitude can we talk about when it comes to Fed cuts with inflation still around those figures?
Yeah, that's an excellent point. And that's why we think it's going to be very measured. Like, they do have room to incrementally cut rates, but it's going to be meeting by meeting. That to be able to forecast sort of a rate cutting cycle that's going to drop 100 basis points or more, it's premature at this time. There is kind of the dual mandate conflict that you mentioned, and the other is with respect to inflation is to like, what will be the drivers to sort of bring it down? Does it have to be growth oriented, or can it be organic? Historically, it needs to be growth oriented to get inflation down. And from the Fed's perspective, we think there's really there's an important aspect to this. It's confidence, market confidence in its ability to get to target and to maintain their inflation fighting credibility. Powell's doing a pretty good job, but he's trying his best to preserve that, and that's what the bank overall is trying to preserve. As we get sort of pressure from the administration to ease rates, in the face of what is still very persistent stuck inflation. So we kind of watch the long end. We very much watch break evens. We're very much looking at term premium in here to kind of calibrate, like, is the market getting uneasy? There is some signs of that, as you pointed out earlier, but we haven't sort of fully capitulated. The bond market is still largely holding together, and particularly important, we think, are those break even inflation rates, 10 and 30 years out, which are holding in reasonably well, but still showing some signs of upward drift.
Yeah, absolutely. Well behaved for the moment, but as you said, also a direction of travel higher. Priya, George touched on the concept of Fed independence, and we have to get to one of the big stories that's happening this week, and that, of course, is what's going on between President Trump and Fed Governor Lisa Cook. What's interesting to me with all the drama of this week, of course, Trump asserting that he can fire Lisa Cook then suing Donald Trump, is that you really haven't seen much reaction in the bond market. We know what the worst case scenario might look like, long end yields going higher, but haven't really seen that anxiety come through in pricing.
Right, and I think, we should look at the bond market, absolutely. I stare at it all the time. The curve has steepened a little bit, but I think you can attribute a lot of other things to that steepening. The fiscal trajectory, global term premium going up. But if really we were concerned about Fed independence really getting challenged here, I think equities would be much weaker. I think credit spreads would have been wider. The dollar would have been much weaker. There is uniform agreement among economists, among market participants, among global policymakers that you want an independent central bank. So I think it's one of the basic tenets of a developed economy of U.S. exceptionalism. I really think the market is saying there are institutional guardrails around the Fed, whether it's the Supreme Court decision from earlier this year, whether it's the fact that there is a diversity of opinion at the Fed. You really don't have clear political leanings at the Fed. I think, we've got the 12 people that vote. You've got that, all the board members. I think the market's saying this is sort of drama. We can look past it. I don't think the market's really seriously pricing in a loss of independence. It would be extremely serious if that happens. Maybe I'm naive, but I do think that those institutional guardrails are there to protect that Fed independence, because I think the president wants an independent, credible central bank, because that 10-year is the policing authority for the market. If the market gets a whiff of a non-independent, non-credible central bank, you're going to see those break-evens much wider. Long end rates will rise. The Fed really won't be able to control the long end. And then, that's when the bond vigilantes sort of wake up, and every market wakes up and takes, notice of that. So I think it is a risk. It's absolutely something we should keep an eye out for, but I would put that in the realm of a big tail risk, maybe starting to get priced in. I think the market's still looking at a credible central bank and the growth slowing, inflation staying sticky, and how we're navigating. Can we stay in that soft landing, and the Fed cut just enough to keep the soft landing going? I think that's the key focus. But you're right, we should all, I think, keep an eye out for whether that independence is threatened or not.